Hello, my name is Roberto Cardarelli, and I'm here to talk to you about the main conclusions of Chapter 3 of the 2008 April World Economic Outlook. The title of the chapter is The Housing Cycle and Its Implications for Monetary Policy, a chapter that I have co-authored with Denise Gan, Alessandro Rebucci, Tommaso Monacelli, and Luca Sala. After years of unsustainable growth, the housing sector is in full retreat in several advanced economies. In real terms, house prices growth have decelerated in a number of countries, and in few of them, like the United States, Ireland, and Denmark, real house prices have actually declined over the last 4 quarters. Real residential investment have also declined in few advanced economies, in particular in the United States, Australia, and Ireland. While few would disagree that such developments are going to have main implications for the level of economic activity, substantial uncertainty still exists on the links between the housing sector and the business cycle, for example, on the magnitude of the impact of changing house prices on consumer spending, and also uncertainty exists on how monetary policy should respond to developments in the housing sector. This uncertainty has probably been compounded by the dramatic changes that have occurred in the system of housing finance in several advanced economies over the last 20 years. Changes that have made it easier for households to access mortgage credit and have presumably contributed to the rapid increase in mortgage debt in these countries. So Chapter 3 is going to examine how changes in the system of housing finance have altered the link between the housing sector and the business cycle and the role of the housing sector in the monetary policy transmission mechanism. And it's going to draw implications for the conduct of monetary policy. The chapter has 3 main conclusions. The first conclusion is that innovations in the system of housing finance that have made it easier for households to access mortgage credit have also made economies more exposed to changes in the housing sector and in financial systems. This is because the larger use of homes as collateral in the lending process has strengthened the feedback from changing house prices to consumer spending via household borrowing. The second conclusion is that innovations in the system of housing finance over the last 2 decades have probably strengthened the role of housing in the monetary policy transmission mechanism. In particular, these innovations have made house prices more closely linked to monetary policy, and the chapter finds that the impact of monetary policy on output is stronger in economies with more developed mortgage markets. Finally, the third conclusion is that monetary policy should take into account the different characteristics of mortgage markets, and in particular, economic stabilization can be improved by a monetary policy that responds to house price changes in addition to consumer price inflation and the output gap. This doesn't mean, though, that monetary policy should target house prices. Given the considerable uncertainty that exists on the shocks hitting the economy and on the effects of interest rates on asset prices, house prices should be only one element of the many that should be considered in assessing the balance of risk to the outlook within a broad risk management approach to monetary policy. Moreover, monetary policy shouldn't be left alone to bear the full weight of responding to house price movements. Regulatory policy has also a critical role to play in preventing inappropriate loosening of lending standards from fueling extreme movements in house prices.